Oh man, I am totally gonna get fired.
What's wrong, Johnny?
What the fuck? Who said that?
It is I, Actual Investing, from the YouTubes.
Actual investing, huh? Well, I am actually screwed because my boss asked me for a stock analysis by the end of the day, and I know nothing about analyzing stocks.
It sounds like you're probably not qualified for your job.
I may have lied on my resume.
Well, lying is bad, but don't worry. I'm going to show you how to analyze a stock from start to finish in just a few minutes.
Thanks, floating lowercase a.
You're welcome, Johnny. What company do you have to analyze?
It's Bob's Lemonade Stand.
Bob's Lemonade Stand, you say? I'm familiar with this company, and I think I can...
And I think I can help you out, Johnny. Sorry about that. Had something stuck in my throat. So let's help Johnny out a little bit and teach him a bit about stock analysis. I feel like I can't talk about stock analysis without talking about this little book that I read recently that really changed things for me. It's called Warren Buffett and the Interpretation of Financial Statements: The Search for the Company with a Durable Competitive Advantage. And yes, that is the entire title. It's an extremely long title. I don't know what they were thinking. But anyway, this book really doesn't take too long to read. If you're a nerd like me, I kind of whipped through it because I really enjoyed it. And it breaks down the three financial statements that every company has. So that's the income statement, the balance sheet, and the statement of cash flows. Those are the three sections of the book. And in each section, it talks a bit about the important characteristics of each of those financial statements and what to look for when you analyze a company. So I'm going to be referencing this book quite a bit today. So I just thought that I would pay it some respect here. So let's take a look at quote unquote Bob's Lemonade Stand. So Bob's Lemonade Stand looks like it's down 45% in the past year, which is probably why Johnny's boss wanted him to take a look at it. He's probably thinking, wow, the stock is down almost 50%. I wonder if there's some value to be had. So that's the first thing when analyzing a stock is try not to pay too much attention to price movements. The stock price is going to be incredibly volatile. So if we zoom out, we can see that Bob's Lemonade Stand is actually up almost 3,000% in the past 5 years. So this is an incredibly well-performing stock even after the recent dip. So you can't just look at short-term price and say, wow, this stock must be so cheap. That's why I look to value a company, not just look at how the stock has moved. Now, when I analyze stocks, I like to use this handy spreadsheet that I put together called the High Quality Company Spreadsheet. I'll also try to leave it in the description of this video. But essentially, I've made a spreadsheet that looks at what I think are the most important characteristics of a high quality company. So I'm going to just quickly tell you what all these factors are, and then I'll talk to you about why they're important. So the factors are market cap, gross margin, SG&A to gross profit, R&D to gross profit, debt to equity, international sales percentage, price to annualized sales, year-over-year revenue growth, dividend yield, PE ratio, and price to free cash flow. So we're going to go through this with Bob's Lemonade Stand, and that way we can analyze the company holistically and see if it's a good value or not, because it's a combination of all these factors that make a company a good investment. It's also very important to know what the company does. So before you start going down the rabbit hole of numbers, make sure you know what the company does and make sure that this is a business that you believe has the potential to stick around for years into the future. In this case, Bob's Lemonade Stand sells beverages, and we know that people are always going to need to drink. It's a necessity of human life. So I think Bob's Lemonade Stand will probably be around for a while. So I think we can dive into the numbers. So let's start with gross margin. So the first thing I do when analyzing a stock is to go to their investor relations page. That's where you're going to find most of the information about the company's financials. All I really do is just Google the company name followed by investor relations and hit search. Eventually, we're going to get to their investor relations page, which should look a little bit like this. I'm not sure why this says Celsius because this is clearly Bob's Lemonade Stand, but anyway, we'll just keep going with it. What we're looking for is something that says financials. From financials, we're going to look for SEC filings. From SEC filings, we're going to click on quarterly filings, and we're going to find a document called the 10Q. The 10Q is a quarterly document that all companies must file with the SEC, and it displays all their financial statements, their income statement, their balance sheet, and their statement of cash flows. The 10K is the same thing, but on an annual basis, and it usually has a bit more detail. But for now, let's look at the 10Q. I'm going to open it as a PDF. So this is Bob's Lemonade Stand's 10Q. what we can do is scroll down until we find the income statement, because that's where we're going to find out information about the company's margins. So I'm just going to go into search and say income statement. Right here we see financial statements. We have the consolidated balance sheets. We have the statements of operation and comprehensive income. Perfect. That's what we need. Income statement. They just said it in a really weird fancy way. So here is the income statement for Bob's Lemonade Stand. Now, margins are important because it shows the pricing power that a company has. A company with stronger margins means that they're able to sell their product for much more than it costs them to make. So that implies that they have some kind of competitive advantage that's allowing them to keep their prices high. Because typically in a capitalistic society, we have other companies that come in and try to undercut because competition is always rampant in capitalism, right? So here what we can see is that they've laid out their revenue at the very top line. So this you can think of as sales. So this is how much lemonade they sold. They sold $402 million worth of lemonade. Good job, Bob's Lemonade Stand. This is in the past 3 months, by the way. And then we can see their cost of revenue. This could also be known as COGS, or cost of goods sold. And then this here is their gross profit. So it cost them $193 million to produce this lemonade, and they sold it for $402 million. So they have a gross profit of $209 million. In order to find out your gross margin, it's very simple. Simply take your gross profit, which is that $209 million, and divide it by your total top line revenue, which is that $402 million, and we can see that Bob's Lemonade Stand has gross margins of 52%. So let's go back to my high quality spreadsheet and put in 52% for gross margins for Bob's Lemonade Stand. The Buffettology book talks a bit about gross margins, and while they don't necessarily give a minimum, I've found that 20% is kind of the minimum gross margin that I look for. I'll make the exception for a couple of percentage points, so if a company has maybe 18, 19% gross margins, I would still consider investing in them, but realistically you want this to be high because it's showing that a company is selling something for much more than it costs to produce. That gives them a good margin of safety. So 52% I'd say is quite good. In my portfolio, the average of all the companies I hold have a gross margin of 48%, for some reference. So 52% is a little bit above my average, so that's nice. Okay, these next two are straight out of the Buffettology book. Warren Buffett likes to look at selling, general, and administrative as a percentage of that gross profit number, and research and development as a percentage of that gross profit number. SG&A, or selling, general, and administrative, is things like staffing and advertising. R&D is developing a product, and you're going to see companies like semiconductor companies spend a lot on R&D, whereas lemonade stands probably won't spend very much on R&D because they don't need to change anything about their product. And that's why Warren Buffett really likes Coca-Cola. Coca-Cola doesn't need to spend much on R&D because they just keep producing the same product over and over and over. So what Warren Buffett says is that R&D to gross profit should not be more than 50%, because at that point, he thinks that the company doesn't have a durable competitive advantage. He thinks that the company is just paying for that advantage. And as soon as that R&D dries up, the company is going to suffer. With SG&A, he didn't really give a guideline, but in my mind, I don't like that to be more than, say, 80%. And as a combination of the two, I don't like these to be more than 100%. So let's find out what we have for Bob's Lemonade Stand. So right here we have selling, general, and administrative expenses. Great job, Bob's Lemonade Stand, for breaking this out very cleanly for us. So we see it's about $115 million. So what I'm going to do is take $115 million and divide it by that $209 million gross profit, and we see that they are spending 55% of their gross profit on SG&A, which is again selling, general, and administrative. To me, that's not too high. The average company in my portfolio spends 40% of their gross profit on SG&A. So this with Bob's Lemonade Stand, and since they're not spending anything on R&D because they're just selling lemonade, this tells me that they're only spending 55% of their total gross profit on operating expenses. So that means they have 45% of their gross profit left over. Now, this might need to be used to pay things like capital expenditures, a dividend, but this is a good way to kind of gauge the financial leverage that a company has. Okay, next up is debt to equity. This is a way to evaluate the balance sheet of a company. The balance sheet is going to list a company's assets and liabilities. The difference between those two is what's known as shareholders' equity. So essentially, if Bob's Lemonade Stand has $2 billion in assets, and assets are anything that has value, right? So assets could be cash, it could be the physical properties that the lemonade stands are on, it could be inventory. Anything that has a value is an asset. You can also have intangible assets, things like patents, licenses, intellectual property. And liabilities are going to be debts. So that might be the loans that Bob's took out to, purchase the properties, or it might be accounts payable could be a liability. So if they have $2 billion in assets and $1 billion in liabilities, they have shareholders' equity of $1 billion, and they have debt to equity of 100% because they have debt of $1 billion and equity of $1 billion. So what we could do is go to Bob's Lemonade Stand and find their total assets and find their total liabilities and do total liabilities to their total shareholders' equity. But what I do, just to make my life easy, is I'll go back to this Yahoo Finance page and type in the ticker for Bob's Lemonade Stand, go to statistics and scroll down, and you will see total debt to equity, most recent quarter. We see that Bob's Lemonade Stand has a very squeaky clean balance sheet. So we can see that Bob's Lemonade Stand has total debt to equity of basically nothing. So that's great. If you see a company with greater debt than they have equity, that tends to imply that their balance sheet may not be healthy. Another way to track the health of a balance sheet is to look at the company's current ratio. And that's simply their current assets, which we can see here at $1.4 billion, and their current liabilities, which is $313 million. So any company's current assets should be much greater than their current liabilities because that shows the short-term financial health of the company. In this case, it is, so we can say that Bob's Lemonade Stand probably has a pretty solid balance sheet. You can dig into this a little bit deeper, but for the first step in analyzing a company, I think this is really all you need. So let's keep going. International sales. To me, I like a company that is diversified outside of just the United States. Most of the companies that I talk about on my channel or that I invest in are United States-based companies, and so I like to see that they've expanded a bit. This isn't necessarily a must, but it's a nice to have. So how do we find their international sales? Well, let's go back to this investor relations page for Bob's Lemonade Stand, and instead of quarterly filings, let's change this to annual filings. Let's pull up the most recent 10K, which again is that annual statement. In the 10K, I'm going to do a Control or Command F and search for geography, or I'm just going to search for geograph. Typically what companies will do is list out their revenue by geographic location. And here we go, we already found it. So the following table sets forth the amount of revenues by geographical location. Awesome. Okay, so let's look at the most recent year, and they lumped the United States in with North America. That's fine. So let's say North America is 1263, right? And total revenue is 1318. So they make 96% of their revenue from North America. So we can say that they have international sales of just 4%. So this tells me that Bob's Lemonade Stand has not really branched out internationally yet. Now, this is a double-edged sword. One, it means that they might have some growth potential in other countries. That's great. But two, it means that they're predominantly exposed to one country's economy, the United States economy. So if the US economy is going through a downturn while the rest of the world is just fine, Bob's Lemonade Stand is going to suffer more than other companies. So this is a potential risk and something to keep in mind. So I'm going to highlight this field in red. Okay, next let's talk about valuation. So price to annualized sales is a very, very basic valuation metric that you can use for a company. And it's going to be different for each company, right? So sales is the very, very top line, not profits. So some companies might have a really high price to sales, but a really low price to earnings if they're extremely profitable. So think about a company like Visa. Visa has a really high price to sales, but on each of those sales, they can squeeze out a lot of profit because they're a very profitable company. So their PE is more reasonable, even though their price to sales is high. So don't just look at price to sales to value a company. Look at a few metrics, but this is one that you can look at. So price to sales is quite easy. We have the company's market cap, which is $7.1 billion, and we're going to find their annual revenue. For this, I like Google Finance. Let's go down to the income statement, and what I do is take the most recent quarter and annualize it, aka multiply it by 4. And that way we can see if they continued doing what they did last quarter for the rest of the year, that's what their annual revenue would be. Sometimes you have cyclical companies where they have a lot of revenue one quarter and then not very much the next quarter. In that case, just add up the past 4 quarters. But for a company that's kind of consistent like this, I'm going to take this $402 million and multiply it by 4, and we get annualized revenue of $1.6 billion. Let's go back to my spreadsheet. Price to annualized sales is going to be $7.1 billion divided by 1.6 billion, and we get a price to annualized sales of 4.4. The average company in my portfolio has a price to annualized sales of 5. So this, I would say, is lower than my average. So that's kind of nice. Now let's look at revenue growth, because sometimes a high valuation might look scary, but when they have extremely good revenue growth like Cloudflare here, it might be worth paying a premium for a company that's growing really fast. All right, so again, let's go back to Google Finance. And really all you have to do to get to Google Finance, if you're unaware, is simply type in the ticker and then the word stock, and then click more info, and you'll get to Google Finance. So this shows the income statement. We can see that they grew their quarterly revenue by 23% year over year. So that's great. So revenue growth, we can say, is 23%. Double digits is astounding. The average company in my portfolio only has revenue growth of 5%, and that's because I have a few companies in there that are kind of weighing it down because they're sort of in a turnaround phase right now. But if you're a growth investor, maybe the average company in your portfolio grows revenues 15 or 20%. But either way, we can say that 23% revenue growth is quite healthy. Dividend yield. If you have a mature company, a lot of times they don't have anything better to do with their money besides give it back to their shareholders. They don't need to advertise more. They don't need to go out and make acquisitions. They are content with where they are. They're a mature company, so they're going to pay out a dividend to their shareholders. Essentially, they're saying, thank you for investing in our company. Here's a quarterly payment. Please keep being invested in our company. So with Bob's Lemonade Stand, they're a smaller company and they're still growing, so they do not pay a dividend. So I'm going to put in 0% for dividend yield. Now, don't just look at a company and say, ooh, it pays a great dividend, I should invest, or, oh, it doesn't pay a dividend, I'm not going to buy. A dividend, at the end of the day, doesn't really matter because, one, there are other ways that a company can give money back to their shareholders. They can do share buybacks where they purchase their own shares, something known as treasury shares, which increases the total percent ownership of the company that you have as a shareholder, because they're reducing the shares outstanding, right? Fewer shares outstanding means you own more of the company with your, fixed amount of shares. So that's a way that they can, pay back their shareholders without paying a dividend. And also, if a company is growing like this at 23%, it costs money to grow, right? You have to advertise, you have to pay really good sales staff to go out and make these sales. So a lot of times when a company is growing, they will choose not to pay a dividend because they feel like it's more important to reinvest in their company as opposed to pay out their shareholders. So don't focus too much on dividend, but it is one thing to look at when analyzing a company. Okay, now my other two favorite valuation metrics, PE and price to free cash flow. PE stands for price to earnings. Earnings is essentially profits, and price to free cash flow is their price to their free cash flows. Free cash flows is anything that the company makes in cash over the quarter, the year, that kind of thing, at a very basic level. It's a bit more complex than that, but we're going to simplify it and say it's the cash that they make in the quarter. Now you might think, shouldn't their profits and their free cash flow be the same thing? And you'd be wrong. Warren Buffett says that earnings is an opinion and cash is a fact, right? So you can have a very high PE ratio and very low price to free cash flow because maybe the company made a ton of cash, but they also paid out a lot of stock-based compensation. That's where the company gives their own shares to their employees, which is technically an expense, but it is not a cash expense. So these are two different things, and I think it's important to look at both. So PE ratio for Bob's Lemonade Stand, we can just simply go back to Google Finance. They're going to give you the PE ratio right here. It's 30. The average company in my portfolio has a PE of 28 because I do kind of like to find value. So I'm looking for companies with lower PEs, but I have a few companies that are really driving up the average, like Tesla and Intuitive Surgical, both very expensive companies that kind of bump up the average. So 30, I don't think it's too high, but it's definitely not low. All right, price to free cash flows. We can either go back to that investor relations page and look at the statement of cash flows right here, consolidated statements of cash flows. So we can use this consolidated statement of cash flows if you'd like. However, I prefer to have someone else do the work for me. I'll go to Google, type in Bob's Lemonade Stand free cash flow. And usually macro trends will display the free cash flow on an annual basis. If it seems wrong, you may want to double check it with that statement of cash flows, but to me, I find this a lot easier than going and digging through the 10Q when I don't need to. So we can see that in 2023, they had free cash flows of 123 million. So price is again that market cap, so 7.1 billion, and we're going to divide that by 123 million in annual free cash flows, and we can see that their price to free cash flows is 58. The average company in my portfolio has a price to free cash flow of 34, so 58 is a bit steep, but we also have to remember that this company is growing quite rapidly. So thanks for sticking with me. These are the 11 factors that you can look at to decide whether a company is a high quality company. I'm going to go through these quickly and give a synopsis for Bob's Lemonade Stand. Bob's Lemonade Stand is a $7 billion company, so that would place them in the small to mid-cap range. Small to mid-cap companies tend to be a bit more volatile, but they could have potentially better long-term returns. However, they might be a bit more risky. They have gross margins of 52%. These are healthy gross margins and shows that Bob's Lemonade Stand has some good pricing power. They're only spending 55% of their gross margin on their selling, general, and administrative expenses, which shows me that while they may be paying for advertisements and good sales staff, they're not overpaying for those things. They don't spend a dime on research and development, which shows that they have a product that they can keep producing over and over again that people are going to keep using. I like to see that. They have a very clean balance sheet with 0% debt to equity. So that means that if the company runs into trouble, they won't have a lot of debt looming over their heads. Keep in mind that if a company does have a high debt to equity ratio, that it's very important to look at the company's free cash flows, right? You'll tend to see that a company with high debt to equity has low price to free cash flows because they're saying, we don't mind taking on a bit more debt because we make so much cash that we can pay it off no problem. So just keep that in mind when looking at debt. They only have international sales of 4%, so they're heavily concentrated in the United States, which is a risk. Their valuation on a price to sales, PE, and price to free cash flow is relatively in line with my overall portfolio, so I wouldn't necessarily call Bob's Lemonade Stand expensive at this point. They're growing revenues by 23% year over year, which I think makes this valuation a lot more attractive. As the company grows and grows, this valuation on a price to sales and usually PE and price to free cash flow is going to go down, right? So if the company stays at the same market cap, but they suddenly have more revenue, more earnings, more cash flows, those valuations are going to look cheaper and cheaper and cheaper. And finally, the company does not pay a dividend, which I think is smart. The company is opting to reinvest their capital into the business to help fuel this 23% growth. I love to see that. Overall, I think Bob's Lemonade Stand presents a nice investment opportunity based on just the financials. So what I would do here is say, okay, I like the looks of this company. I'm going to add it to my watch list. So I'll add this company to my watch list, and then I'll go out and do more research about the actual company. Does the company have any lawsuits against them? Was there any short reports that might have uncovered some dirt on the company? Is there anything weird going on with their C-suite? So things like their CEO and CFO, do they keep having turnover there? Is there a little bit of trouble with the company in that respect? What do people think of the company's products? Go look at Bob's Lemonade Stand product reviews. See if people like drinking their lemonade, or see if people think their lemonade is gross. See if they have any competitors. These are the types of things that I would do a more deep dive on after looking at the financials. So I hope this video today helped you out, and I really hope that Johnny does not get fired by his boss. Even though he lied on his resume, he probably deserves to be fired, but that's okay. We'll help him out with this quick, 20-minute video. Thank you guys so much for watching, and if you like this kind of silly video, please hit the like button and please subscribe if you're new. And let me know if you have any other questions about analyzing a stock down in the comments below. I will read all of the comments and respond to them. I really appreciate you guys sticking around for the whole video. Thanks so much for watching, and have an amazing day.